Hello everyone. Sometimes it might seem confusing to prepare journal entries, adjusting journal entries when cash is paid for expenses that go over one accounting period, or when cash is received for revenues that go beyond one fiscal year. In those cases, adjusting journal entries have to be made. And today we'll see an example that illustrates two methods or two ways of recording such transactions. So we have this question here, which reads that on September 1st, Apertura Financial Inc. paid $48,000 in advance for 1 year of property insurance expense for one of its offices in Toronto. Prepare journal entries for Apertura Financial to record the September 1st journal entry and the December 31st year-end adjusting entry. Show two ways of recording the journal entries using the standard and expedient recording methods. Okay, so we will prepare two sets of journal entries. In each set we have an entry for the September 1st transaction and a closing entry for the December 31st transaction. Under the first approach, we will treat the September 1st expenditure as an asset, and under the second one we'll treat the September 1st expenditure as an expense. So the first approach is called the standard approach. It's also called as the asset approach, where we should treat this expenditure as an asset on September 1st. So we have this prepaid insurance account, asset account, where we record this $48,000 as an asset. We also have a cash outflow of $48,000 that is recorded as credit on September 1st. But you'll realize that by December 31st, the company will not have used all of its prepaid insurance, which is $48,000, right? It will only use a portion of this expense because the total amount of $48,000 was paid for 1 year, and from September 1st to December 31st there's only 4 months. So let's account for that portion that the company will have used by December 31st. So this is September 1st, where the initial transaction happened, and here we have December 31st. So from September 1st to December 31st there's 4 months, and the total payment was made for 12 months, and there's still 8 months that are remaining after December 31st. So to account for the portion of this expense that is from September 1st to December 31st, we need to divide that 4 months by 12 and multiply by the total amount of expense or the cash outflow that was made. So this gives us 1/3 of 48,000, 16,000. So 16,000 is the portion of this expense that the company will have used by December 31st. So to account for that, so let's create an adjusting journal entry for December 31st. So we will have this expense, that's called operating expense of $16,000 for the 4 months, and we will have another entry which is prepaid insurance, where we credit $16,000 that was used in the past 4 months by December 31st. So this is an adjusting journal entry for the prepaid insurance account. For for T accounts, it will look like this for prepaid insurance. Prepaid insurance, we have initially $48,000 here, but we have an adjusting entry here for $16,000. So the net prepaid expense, prepaid insurance, is $32,000. For operating expenses, we have 16,000 that the company incurred by December 31st. So this is under the standard approach. There's also the Expedient approach, which is also called the expense approach, under which we should treat the September 1st expenditure as an expense. So September 1st, we have this operating expense of 48,000, and we paid cash for this expense, $48,000. However, as we saw here, Aperture Financial will not have used all these expenses in that year by December 31st. So we have to account for the remaining portion of this expense that will go to the next year. So to do that, we'll have this prepaid insurance account and this is for December 31st. Prepaid insurance as of December 31st, we'll have 48,000 minus 16, because that's the amount that we'll still have by the end of the year. So 32,000 prepaid insurance, and operating expense is also $32,000 by December 31st, and that we will allocate for the next year. So if we put it here in the form of a T account for the two accounts, it will be clear, I believe. So here we have the prepaid insurance, which is $32,000, which is coming from this section here, and we also have operating expense, which started as $48,000, but we have an adjusting entry here on December 31st for $32,000. So the net balance here is $16,000 that is allocated for the year, for the period from September 1st to December 31st. As you can see here, on the two approaches, and both approaches, the outcome is the same, where the prepaid insurance has a balance of $32,000 and the operating expense account has a balance of $16,000. So I hope this illustrates the two methods that you can use when doing adjusting journal entries for accruals or deferrals. Thank you.